Most retail participants focus on headlines. Institutions focus on funding. Today, we're walking through 10 developments across Bitcoin, decentralized finance, tokenization, stablecoins, and decentralized AI that could influence how capital, regulation, and market infrastructure evolve over the coming years. As always, this analysis is educational and based on public available information and historical observations, not financial advice. The objective is not prediction. The objective is risk analysis. We'll examine where the opportunities may be emerging, where the structural bottlenecks remain, and what could break each thesis. Let's start at the foundation of the crypto ecosystem, Bitcoin itself. Bitcoin core developers propose removing redundant RBF signaling from wallets. Think of this update like a mail delivery system removing special markings that make certain packages easier to identify. From a system design perspective, eliminating these transaction markers reduces one of the signals that blockchain analytics firms can use to classify activity. If broadly adopted across wallets, it could incrementally improve baseline privacy and strengthen Bitcoin's censorship-resistant characteristics. For institutions conducting sensitive settlements, a more standardized transaction framework may provide a cleaner and more predictable operating environment without requiring additional privacy layers. The primary risk is implementation fragmentation. If major wallet providers do not adopt the change consistently, the privacy benefits could partially disappear because non-standard transactions may become even easier to identify. There is also operational risk for businesses that have spent years integrating analytics tools, compliance workflows, and accounting systems around existing transaction patterns. In practice, improvements to protocol privacy often create temporary friction for enterprises that depend on transaction visibility and monitoring. While Bitcoin developers are refining the base layer, the next story highlights what happens when vulnerabilities emerge higher up the stack. And when millions of dollars are involved, software design mistakes become very expensive very quickly. Taiko bridge explorers identify exploit draining ERC20 assets. That's the case. From a forensic risk perspective, bridge exploits remain one of the largest unresolved risks in crypto infrastructure. When attackers are able to manipulate validation mechanisms and extract funds, it reinforces a pattern institutions have seen repeatedly across the industry. The larger issue is not the dollar amount lost. It is the confidence lost. For compliance teams and institutional operators, every successful bridge exploit raises questions about whether cross-chain infrastructure is mature enough for large-scale deployment. Complex systems often create complex failure modes. At the same time, major security incidents frequently accelerate infrastructure improvements. Security failures expose weaknesses that may otherwise remain hidden for years. In this case, identifying flaws in proof validation creates pressure to implement stronger verification mechanisms and more robust security architecture. Historically, many of the industry's most resilient systems emerge only after surviving severe real-world stress tests. While painful in the short term, these events often contribute to long-term hardening. Security failures rarely remain isolated. Once confidence begins to weaken, liquidity often follows. And that brings us to a stablecoin-related event that illustrates how quickly risk can spread through interconnected DeFi systems. Altura begins winding down stablecoin yield following systematic panic. Viewed through a risk management lens, the orderly wind down of this vault represents a defensive response designed to preserve remaining capital. Rather than allowing disorderly liquidations, management chose a controlled exit after instability emerged in a related stablecoin. Events like this force the market to reassess which yield models are sustainable and which depend on fragile assumptions. Over time, capital tends to migrate towards structures backed by deeper liquidity, stronger collateral, and more transparent risk controls. The concern is contagion. When instability in one asset causes withdrawals and stress in another seemingly unrelated protocol, it demonstrates how interconnected DeFi liquidity systems remain. Institutional investors evaluating the sector continue to see concentration risk, dependency risk, and smart contract interconnectedness as major obstacles to adoption. For many participants, recurring defects and emergency wind-downs reinforce concerns that the industry still has significant risk management gaps to address. As decentralized finance works through these operational growing pains, another battle is taking place in parallel. This one involves policymakers, tax treatment, and the regulatory clarity that institutions have been demanding for years. Crypto industry advocacy groups urge Congress to approve the taxation bill. The potential benefit here is straightforward. Regulatory clarity reduces uncertainty. If standardized taxation rules are established for staking and related activities, corporations, pension funds, and other institutional participants gain a clearer framework for evaluating participation. CFOs and compliance departments generally avoid ambiguity. The more predictable the tax treatment becomes, the easier it is for organizations to allocate resources toward blockchain infrastructure and validation activities. However, legislative outcomes remain uncertain. Delays, amendments, or shifting regulatory interpretations could prolong the ambiguity that currently discourages participation. There is also the risk that reporting requirements become overly burdensome, creating barriers for smaller operators while favoring larger organizations with dedicated compliance resources. Regulatory clarity can be positive, but the details often determine who benefits and who bears the cost. While regulators debate how decentralized networks should be treated, some projects are attempting to remove centralized decision makers altogether. That ambition sounds attractive in theory, but it introduces an entirely different category of risk. Bittensor founder outlined strategy for complete network decentralization. From a systems governance perspective, execution risk is substantial. Transitioning from a globally distributed AI ecosystem to a fully decentralized governance requires coordinating incentives across thousands of participants. Without strong safeguards, voting power can become concentrated among large stakeholders, potentially distorting network incentives. Institutional investors often view governance transitions cautiously because instability during implementation can create significant uncertainty regarding future network behavior. The upside is that successful decentralization can reduce single points of failure. A network that does not depend on a central operator is generally more resistant to censorship, regulatory intervention, or corporate policy changes. For developers building AI models and applications, a decentralized governance framework may provide stronger assurances that access rules and incentives cannot be changed unilaterally. If executed successfully, it could strengthen the long-term durability of the ecosystem. Decentralized networks are trying to remove centralized controls, yet central banks are simultaneously adapting their own frameworks to accommodate digital assets. The next development illustrates how traditional institutions are gradually reshaping their rules around stablecoins. The Bank of England modifies the systematic stablecoin policy and issuance limits. The removal of individual holding caps represents a meaningful step toward broader stablecoin adoption within regulated financial markets. For corporations and financial institutions, transaction efficiency matters. A clearer regulatory framework makes it easier to evaluate stablecoins as a potential settlement layer for high-volume transactions. From an institutional perspective, regulatory certainty often matters more than technological innovation alone. The risk lies in the details of implementation. Issuance caps, reserve requirements, and extended rollout timelines may limit the pace of adoption. While large limits may appear generous today, they can become restrictive if usage scales rapidly. Additionally, strict reserve requirements can compress profitability for issuers and create incentives for activity to migrate towards less regulated jurisdictions. When a major central bank adjusts its framework, global investors pay attention, and few investor groups are more conservative than pension funds. That makes our next development particularly noteworthy. Japan's National Business Corporate Pension Fund proposes crypto allocation plan. Pension funds represent some of the most conservative pools of capital in the world. Even a modest allocation to digital assets signals growing institutional acceptance of the asset class. Unlike speculative capital, pension capital tends to operate on long-term horizons. If broader adoption follows, it could provide a more stable source of demand and further normalize crypto exposure within traditional portfolio construction frameworks. Execution, however, remains challenging. Pension funds operate under extensive governance requirements, fiduciary obligations, and compliance reviews. Regulatory complexity, custodial requirements, and public accountability create substantial barriers to implementation. Even small allocations can face intense scrutiny if market volatility generates short-term losses, potentially slowing adoption across the sector. While pension funds are evaluating exposure to digital assets, financial institutions are also exploring ways to bring traditional assets directly onto blockchain infrastructure. The scale of that trend is becoming increasingly difficult to ignore. Tokenized real-world assets market cap just tops $51 billion. Crossing the $51 billion threshold suggests that tokenization is expanding beyond stablecoins into broader financial markets. Tokenized equities and other real-world assets offer the possibility of improved accessibility, fractional ownership, and potentially more efficient distribution. For financial institutions, the opportunity is not merely digitizing assets. It is potentially redesigning how ownership, settlement, and transfer processes operate. Yet, fragmentation remains a major challenge. Competing tokenization standards, limited interoperability, and inconsistent legal frameworks create barriers to scale. Many institutions are building proprietary systems that do not seamlessly connect with one another. Until regulatory standards and technical standards mature, liquidity may remain divided across multiple isolated ecosystems rather than forming a truly global marketplace. Tokenization is one thing. Direct participation by major financial companies is another. The next story shows a global payment company moving beyond experimentation and becoming part of the infrastructure itself. MoneyGram enters Solana network as active infrastructure validator node. When a major remittance company operates a validator node, it represents a deeper level of commitment than simply integrating a blockchain product. Validator participation remains helping secure and maintain the network itself. For the broader industry, it provides a tangible example of a traditional financial institution viewing blockchain infrastructure as operationally relevant rather than purely speculative. That distinction matters. However, institutional participation can introduce new governance questions. Large regulated entities may face legal obligations that differ from those of independent validators. Over time, concerns could emerge around concentration, compliance-driven transaction filtering, or the growing influence of corporate participants within public blockchain ecosystem. The challenge is balancing institutional adoption with decentralization objectives. A remittance giant becoming part of blockchain infrastructure is significant, but our final development may represent an even larger convergence between traditional finance and digital assets. The ICE and OKX form joint venture targeting tokenized equity markets. This partnership between the parent company of the New York Stock Exchange and a major digital asset platform represents one of the clearest examples of institutional convergence we have seen. Rather than treating crypto markets and traditional markets as separate ecosystems, the venture attempts to build infrastructure connecting the two. If successful, it could help establish tokenized assets as a legitimate distribution channel within regulated financial markets and accelerate broader institutional participation. The risk radar is substantial. Regulatory approvals, compliance requirements, custody standards, and cross-jurisdictional rules all represent potential bottlenecks. Historically, many ambitious financial infrastructure projects have moved far slower than expected due to regulatory complexity. Investors should focus less on announcements and more on measurable implementation milestones as they emerge. Remember, you can join the other channel members and get early access to these videos. And you can also find my weekly write-up on Substack at AssetLens. Across all 10 developments, a common pattern emerges. The industry long-term direction is increasingly being shaped by infrastructure, regulation, security, governance, and institutional integration, rather than speculative narratives. Some developments reduce risk, others introduce new forms of risk. This is why institutional analysis always begins with the same question. What could break the physics? Whether we're evaluating Bitcoin protocol upgrades, DeFi security events, stablecoin frameworks, pension fund adoption, or tokenized equity markets, the most important signals are often found beneath the headlines. Let me know which development you believe carries the greatest long-term impact, and I'll see you in the next Asset Tech analysis. Thank you.